The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Lobsher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Lobsher. Thank you so much for joining me for another episode of Cashflow Ninja and spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. I've got a fantastic show for you today. I'm joined by Kevin Nichols with Penumbra Solutions. Kevin has been on the show several times over the past 6-7 years, sharing more about the asset class of life settlements. If you have not heard Kevin speak about life settlements and this is your first time, I would highly recommend you check out all the past episodes. Just go to cashflowninja.com and type in Kevin Nichols, and you'll find all of the previous shows I have done with Kevin over the past 6 to 7 years. Kevin, great to see you.
Great to see you, MC.
So we've got a lot of new listeners and viewers. For listeners and viewers that's not familiar with Kevin Nichols and Penumbra Solutions, as I shared in the intro, you can check out all of the past interviews I've done with Kevin on the asset class of life settlements at cashflowninja.com. For our new listeners and viewers, Kevin, can you just give a little bit about your background and journey and what you're up to these days?
Sure. My background was in financial planning for many years. And about 15 years ago, we opened our first private equity fund, investing in life settlements. My partner, Jim Walsh, and I had both invested in life settlements personally and found them to be exceptional. Never had an issue at all. And so we decided, what if we pooled our investments together so that we could help to kind of have a more predictable cash flow, predictable yield. And so we looked into opening up our first private equity fund together. We researched that and wrote the document ourselves. Took us almost 2 years, and brought that to market. And from there, all of our planning clients loved it and decided to be a part of it. And then some other agents came to us and said, "Hey, can we recommend your investment to our clients?" And then that went exceptionally well. And then it was like, giving birth to a gorilla. It was huge. And so we stopped doing planning personally ourselves. And now all we do is manage these private equity funds. We're in our 11th fund. And they all are almost identical in terms of how they work. And, they're all performing. And it's, the life settlement space is something that is utilized by ultra high net worth investors and has been for many, many years. And it works beautifully today, just like it did back in 1911 when the first life insurance policy was settled for somebody. So it works out. They work out well. They work beautifully, and that's all we do. My daughter works for us, Holland, and then of course there's Jim and I. So it's been good.
Now, one of the reasons why I wanted to have this discussion, I can't think of a more timely time to discuss life settlements as people are planning and looking at the environment. I mean, we've got a lot of uncertainty globally. Pick your area, whether it be geopolitical, political in countries, the economy of countries, markets. So a lot of uncertainty, a lot of unknowns. And then also there's a lot of disruption with AI coming in, disrupting a ton of economies and so forth, which brings about a lot of chaos in itself. And that is without, all of the things happening in the financial space. We've had banks, the banking collapse have started. We've had 5 banks went down earlier this year. 2 more just went down. We had downgrades by rating agencies of, 10 banks, 11 are on watch lists. And that's usually not a good sign when they start to do that because they're always late to the party. And which, if this banking collapse starts to continue, you're going to see equities hit, you're going to see bonds hit, and bonds are also in a little bit of trouble, which is why banks are in trouble in the first place, because of the interest rate spikes. Right. So the financial sector is there's a ton of uncertainty, and it looks like there's going to be chaos. Then we haven't thrown in the possibilities of World War III, which is now geopolitical, and then of course we're coming up to yet another election in the United States, and I know other countries have them too. And for the most part of the world, you have very polarizing political environment. So a ton of just, I would say a lot of powder kegs I just mentioned here. So I couldn't think of an asset class that if you're thinking of like, hey, what do I do that has some predictability, that has some security? Is life settlements a fit? How would you, and maybe if you could just explain again what life settlements are, how they work, and then how they would kind of fit into a very good risk management strategy for the environment that I just mentioned.
Absolutely. The interesting thing is life settlements have been around for over 100 years. And, the beautiful thing about it is, what we do is we buy life insurance policies from people who no longer need the policy or no longer want it or no longer can afford it. And we pay them for the policy. We always pay them more than the cash value or more than the insurance company would give them for it. And then we pick up the premium payments. And then when the insured passes, we collect the death benefit. And it's very simple. It's very boring, quite frankly. The beautiful thing about it is, the insurance companies, all of our policies are bought from individuals, and the average age is over 85 years. In fact, right now, the average age is over 92, which is really kind of ridiculous. But I mean, it is what it is. So all of the insurance companies that underwrite these policies that we buy are all A or better rated. Okay. They're the Mass Mutuals, the New York Lifes, the Prudentials of the world. And so what we do is we buy our growth at a discount in advance. Typically, we use what's called an equity multiplier. By that, I mean, if we have a $10 million fund, we're going to buy life insurance policies that are going to yield anywhere from, say, $35 to $40 million in death benefits. So 3.5 to 4 times our money, or a 3.5 to 4 equity multiplier. From there, some of these people are going to live long, and it eats into that. But generally, an average investor is going to see roughly, say, 2.5 to 3 times their money as an equity multiplier over the life of the fund, which should be, in the range of 8 years, 9 years. So the internal rate of return should be anywhere in the range of 15 to 17. Some of the funds are doing better than that. Some are not doing as well. But our target yield for all of our funds is 10 to 12% annualized net of all fees, and our fees are very low. It's funny. I just got a prospectus from a guy who manages private equity funds, and they buy trailer parks and self-storage units. And I thought, man, that's an investment that I might be interested in. And I looked at it, and the company, their carried interest in the profits is 30%. And I thought, dear God, how do you raise any money, at that level? And the truth is, people don't read it. They don't understand it. They don't investigate. Our carried interest, when we have a 2.5% management fee. That's it. So when a policy matures, we get 2.5%. That's all. And we don't get that until the policy matures. So we get paid when the investor gets paid. But 30%, man, I don't know how investors even get their money back at that rate. So we set our funds up initially for ourselves, our family members. My dad was our first investor. Sadly, my dad passed about 3 months ago. So it's been a rough year for us, personally. But we wanted it to be extremely low fees. We wanted it to be well managed. And that's what we've done. We've not changed our fee structure since day one, except to lower our fees, because we collect up to we collect 1.5% of whatever is invested as what is known as an O&O fee, an organizational and offering fee. And that is for setting up the escrow, because we never touch the client's money. We don't even have access to it. Bank of Utah manages all of that right now. They manage all our escrow reserve accounts, which right now is probably in excess of about $20 million. But we don't ever touch a client's money. We pay for the escrow in advance, in cash, to the bank. So they manage all of that. So the O&O fee goes for legal, accounting, escrow, printing, what have you. So 1.5%. Now, initially we had charged 1.75% because we used to use a different escrow company, and they were higher priced. Beyond that, we have a 2.5% management fee at the back end that we get when the policy matures. That's it. There are no recurring fees, no ongoing fees, nothing like that. There's no maintenance, no fees at all. So the only fee an investor would have would be if they have if they invest through an IRA or a 401k or something along those lines, they're going to need a custodian, and the custodians will charge them a custodial fee. We've negotiated pricing with a specific custodian that works very well with us. It's Vantage IRAs, and in Arizona, they charge, I think it's $175 a year. There may be a $250 startup fee for the first year. That's it. That's the only fee they have. So it's very simple. It's very lean. And again, every single dollar we know what a policy is going to be worth when we buy the policy. What we don't know is when. And of course, that's a key component of calculating an XIRR return. So when we buy a policy, we know what the growth is going to be. We just don't know when. So, I mean, if somebody came to you and said, okay, I've got this stock and I think you should invest in it, MC, and you say, yeah, it looks like a good deal. And so you invest money, then the key piece of information that you're missing is, when do I get out? What's my growth going to be? What's going to be the high point? I mean, if you knew that, if you could pick the highs, I mean, my heavens, you'd be more wealthy than Warren Buffett, because you know when to get out. See, everything we buy, we know what the high is going to be, and when it gets to that point, we get it. I mean, it's guaranteed by American Air better rated life insurance policies, which, as you well know, being in the business since 1845, no B plus or better rated life insurance company has ever failed to pay a death benefit. And so we use only A-rated companies. They are all part of the legal reserve system for life insurance companies. But these are the strongest financial institutions in the world, much stronger than the banks. It's really just kind of a no-brainer when you think about it. We've got personally a significant amount of our own personal wealth in these funds. In fact, if you were to go across all 11 funds, we're the largest shareholders across all 11 funds. We're not the largest shareholder in any one fund, but we do invest in every single fund right alongside your investors. We think it's important that we have skin in the game, or as they say here in Texas, that we eat our own cooking. So it works great.
I want to take a moment to share something very important right now. Are you trying to figure out how to protect your savings from the banking collapse, which has already started, and the coming financial crisis? Most banks will fail. Deposits that are not insured by the FDIC will be lost and there will be bank bail-ins. And this collapse in the banking system will lead to chaos in the financial system. Banks also provide loans to real estate investors. So what do you think is going to happen to lending in the event of a banking and a financial crisis? You can be proactive and position your savings to protect it and also have access to it, to use it to buy discounted assets by positioning it in your own banking system through the infinite banking concept strategy. Producers Wealth has put together a presentation at yourownbankingsystem.com where you will learn how to position capital outside of the banking system and the Wall Street casino, just like the ultra wealthy, to protect it and create a pool of tax-free liquid capital to capitalize on the massive opportunity to buy discounted assets, which is coming. You can access the presentation at yourownbankingsystem.com. That's yourownbankingsystem.com. No, that's great. I appreciate you sharing that. One thing I just wanted to hit on is that there's a settled court case on this, which makes it legal, because that's a frequently asked question that people have. And the other thing is also, why would people sell it? Well, there's many reasons why people would end up selling their life insurance policies. I mean, a perfect example is 2008, 2009, right, where the majority of Americans and people around the world get wiped out in the equity in their house. So that gets wiped out. Their equities get wiped out, and they have no other financial resources, but they still have a life insurance policy that they can sell and get 4 to 5 times of the equity built up in that policy so that they can live out the rest of their years comfortably. So it is a win-win. I know that the first time, you always share this with people, they're like, wait a second, how is this legal? And how does the other party benefit? So we've covered this in depth in a separate episode. And you answered the question already about self-directed qualified plans. This is a security, so people should just be aware of that too. It's treated as a security. And the other point that I just want to make is, you mentioned, well, if you could pick the high point and get out at the high point, you'd be as wealthy as Warren Buffett. Funnily enough, Warren Buffett is one of the biggest buyers of life settlements out there in the market. Bill Gates too, right? So you got Bill Gates, Warren Buffett, all these guys. And of course, with insurance companies, Buffett loves insurance companies. He's biggest shareholders in Geico. And then institutional investors love these. And what I found fascinating, I really go down the rabbit hole and deep dive when I look into assets and investments. What I found fascinating is, within a risk management strategy of life insurance companies, they buy each other's life insurance policies.
Absolutely interesting, because this investment, the biggest investor in life settlements, you mentioned Buffett, you mentioned Gates. Buffett invests both individually and through Berkshire, but the biggest investor in life settlements is AIG. Now, they don't invest through their own name, obviously. They have another company that they've set up that they buy life settlements through. But they are, without question, the largest investor. So you might have to, you'd ask yourself, why would they do that? Well, because they know that their money is 100% guaranteed. It's absolutely guaranteed. They know they're going to get paid. They know how much they're going to get paid. What they don't know is when. And so AIG is the largest investor in this space. You mentioned, is it legal? And the answer is yeah, absolutely. Because if you go back to the first life settlement that we know of, and that was in 1911, well, the first time that it was challenged. 1911, Grigsby versus Russell went all the way to the Supreme Court. Supreme Court determined that if you have a life insurance policy and you've gone past the contestability period of 2 years, it is personal property and you can sell it. Whoever you sell it to does not have to have an insurable interest. And that case law has stood the test of time. It's been challenged, and it's always come back that this is this is the law of the land. In fact, the opinion was written by none other than Oliver Wendell Holmes. So it's completely legal. One thing that a question that we do get quite a bit is people will say, "Oh I talked to my financial advisor and he said I can't buy life insurance policies inside my IRA." That's true. You cannot. By investing in life settlements through us, you're not. And if you look into the reason why you can't buy life insurance policies inside your IRA, it's very simple. Because if you have a whole life insurance and you build up cash value in that, and in retirement you decide to borrow against that policy, okay, use it as collateral, which is a very sound financial strategy. If you could do that inside an IRA, then you could invest money tax deferred, and then get paid out in retirement tax free. Well, the government's not real big on no tax ever. Okay. So they don't allow it through an IRA. First of all, the way we do it, we give up that status of tax-free distributions. In other words, when a policy is settled to us, we have to pay tax on the death benefit, and it's taxed as either ordinary income to an IRA investor, or as if you invest with just cash, it's part of it is going to be capital gains, and some of it will be ordinary income. So we don't have that problem at all. And people who continue to espouse that you can't invest in a life settlement fund through an IRA are 100% misleading their investors. And it's typically because they've got skin in the game and they don't want to lose an investor. Because every time, if you have an advisor who is paid through the assets under management model, then every time you make an investment outside of something that he can control, he loses income. And he's not about to recommend that you do that. So, but yes, it's a very sound investment that most people have never even heard of. Yep.
And so you're at Cashflow Ninja. I mean, my job is to bring ideas and education to folks about different asset classes. So this is, again, with the picture that I painted of chaos, which I believe is going to be the next year is going to be full of it for many different reasons. If you are looking at positioning capital and you're looking for more certainty, for guarantees, kind of have an idea up front how this is going to play out, this is a great asset class and investment to explore. What you also have to be aware of is there are, like, as with anything that you do, there's pros and cons, right? The cons, like one of the things that I would share is this is not a cash flow play, number one. So if you're looking for a cash flow investment, this is not it.
Growth.
And then the other thing, your capital is tied up, right? For 5 to 7 years. That's why I preface it by saying for 5 to 7 years, as the chaos unfolds, and you don't want to be checking your stock portfolio every day and almost faint or get a heart attack with a lot of reds in there, then it's good that it's 5 to 7 years. If you're looking for cash flow and if you're looking to access that capital within that 5 to 7 years, this isn't that type of play. So maybe you can just, elaborate on what I just shared, what people should think about when they explore this.
When an investor comes to us, what I tell investors is this: look, if you know you're going to need this money inside of 10 years, we're even more conservative, inside of 10 years, then don't put it here. Okay, put it somewhere else. There are plenty of investments that have liquidity. We do not have liquidity built in. We do not have a liquidity feature in this fund. Think of it as you and your 10 best friends go and buy real estate. You buy a piece of land. And you know that it's going to grow, and so you buy it and hang on to it. And one of your friends says, "Hey, I need my money back." Well, okay, if you need your money back, then we're going to have find somebody to take your place. Okay, so when you're in, it needs to be money that you're not going to need. And I tell people 10 years. And the truth is, you're going to start receiving distributions in about 5 to 7 years. Now, there will be policies that mature well before that. In fact, every single policy, every single fund has had maturities inside the first year. But those maturities are not distributed, which means that you're not going to get taxed on it. Well, you are and you aren't. The point is, there will be maturities that occur inside the first year. They're held at Bank of Utah. And the reason they're held is because we have to continue to make premium payments on these policies. And so we use those maturities early on to replenish the premium reserve account at Bank of Utah. Then after about 5 to 7 years, you kind of reach a tipping point, as Malcolm Gladwell would say. You reach a tipping point where you've got sufficient cash in the fund and you no longer have the obligation of the majority of your policies, the premiums going forward. And so we make distributions then on a quarterly basis. They're made directly to you. If you have an IRA, they are sent directly to your IRA custodian. And if you are a cash investor or through some other form, an LLC, a business, just a family trust, or just as an individual, we wire the funds directly to your bank. So it's very simple, but it's not liquid. That's the key. It's not liquid.
Yeah, absolutely. And then Kevin, on the management side too, one of the risks too is, well, as an investor exploring managers of like funds, one of the things that people always have to look at is the big part of the secret sauce is managing premiums, right? Because you bought a bunch of life insurance policies. Now in this fund, well, they still need that. You still have to pay premiums on them. So the management is actually a very, very big part of this, of it. And this is one thing that investors, if you're doing your research and looking into this stuff, you should be very aware of it, because like any niche that we've shared or any idea or asset class, there's a lot of nefarious characters in every single one of them. And then there's also folks that they don't have the experience. And from a management standpoint, they kind of like do it a little bit more cowboyish, right? Not that there's anything wrong with being a cowboy, but if you don't manage it properly, there are funds that would give you premium calls. Well, what does that mean? That means that they didn't manage the fund properly. They're out of money to pay the premiums on the policies, and now they have to go back to investors to get more money. Maybe you can just share and speak to that, because I think that's also very important for people to know, because just looking, like I said, going down the rabbit hole personally and looking into this, there's a lot of these small little things that people don't think of. That's massive.
Most of the funds that have premium calls is because they deployed too much of the capital in purchasing policies. As I indicated, we're looking for 3.5 to 4 times our money. If we raise $10 million and we say we purchase $40 million of death benefit, that's an equity multiplier of 4. But bear in mind that if we raise $10 million, we're only going to deploy $6 million to get that $40 million of death benefit. We're going to reserve 40% of whatever we raise for premiums for the first 2 to 2.5 years. And then from there, we plan on the maturities replenishing that. Okay. Companies that get into trouble typically are only holding back 10 to 15% for premiums, and they're investing, $8.5 to $9 million to buy the policies. So there's a greed factor in there as well, and then of course the investors get caught out. Now, if there's a premium call, it's not the end of the world. It's just that there haven't been enough maturities to cover, to replenish the premium fund. We've never had a premium call over 11 funds in 15 years. That's not to say we wouldn't, but so far we've been very conservative and we haven't had to.
I want to take a moment to recognize one of our sponsors, Penumbra Solutions. Life settlements investments have allowed financial and banking institutions to not only buy their equity contractually, but also diversify their capital from any economic, market, and geopolitical risk. It's been part of the billion-dollar blueprint followed by institutional investors. If you're an accredited investor, you can also now participate in this vehicle with enormous growth potential. You can watch an informational webinar presented by one of the premier organizations providing live settlement investments, Penumbra Solutions, at cashflowninja.com/live settlements. That's cashflowninja.com/live settlements. The password to access that webinar is Penumbra, all lowercase. I think that's very important to know too. And then also, just in the space as a whole, of live settlements, what are you seeing there or now? What are some current trends? People have asked questions on, from the events of 2020. Has that impacted? What are some of the things that you're seeing?
The biggest variable is trying to determine life expectancy. And that's very difficult to do. That's one of the reasons that we focus on insureds who are over 85 years old, because law of large numbers tells us that how long will a completely healthy 85-year or 90-year-old live? And the answer is generally not beyond 95, 96 years old. But we do get two medically underwritten life expectancy estimates on every single person with whom we do business if we're going to purchase a policy. But the older they are, the less we really have to rely on those, because we use the CDC's actuarial tables, and we also use the insurance industry's actuarial tables called the BBT tables, which is more conservative. In looking at those, a lot of people have said, how does AI play into this? And the truth is, it's yet to be seen. If our artificial intelligence can give us a more accurate estimation of when someone will pass, of course, we utilize that. But we hire a company to help us manage premiums so that we pay the least amount of premiums as we can without putting a policy into grace or, God forbid, lapsing a policy. But we pay for that, and they make sure that we pay the least amount on every single policy. It's called premium optimization. Then furthermore, once we make the premium payment to the insurance company, they follow up inside of 2 weeks and make sure that the premium was applied to the correct policy. Believe it or not, sometimes the premium payment is misapplied. Then they also track the insureds to make sure that if somebody passes, that we're notified so that we can file for the insurance claim. And the way that they do that, there are a couple different ways that they do that, but as a last resort, they actually physically call the insured every month and say, hey, just checking. And some of these people are they don't have many friends, and so they look forward to that call from the company. See, yeah, I'm still here, I'm still kicking. But if you think about it, it's kind of a morbid way to make a living, but it's got to be done. So we want to make sure that we are informed as soon as possible when an insured passes, so that we can file the insurance claim with the company.
Yeah, AI is interesting just to see it in the life insurance industry already. I mean, it's the life insurance industry, or insurance in general, right? Is a generalization. Even like the property and casualty and other lines of insurance, it's already like just it's incredible with algorithms how accurate they are. If you take like property and casualty, just an automobile and a zip code, they can nail it down of how many drivers there are, the ages of the drivers, and then come up with the probabilities of how many fender benders, how many cars get totaled, how many accidents total, and then the ages of the drivers, and then work out a rate based on that. And they're off by very, very little. So it was already a freak show before AI. So it's going to be interesting to see where AI takes this in the insurance industry, and then obviously in the niches that we're in, more specifically the life insurance part of it too. It's very interesting stuff.
Yeah, absolutely it is. Absolutely it is. Exciting times.
I want to acknowledge one of our sponsors. Are you ready to ride the wave of success in the booming car wash industry? Tommy's Express Car Wash is the cutting-edge brand that is revolutionizing the way we clean vehicles. Demand for top-notch, state-of-the-art tunnel car wash is skyrocketing. Institutions are diving in head first, and the real asset investor is already a step ahead. They have a world-class operations team, and they're building a portfolio of Tommy's Express car washes that's on track to become one of the largest privately owned car wash portfolios in the United States. The margins on a stabilized Tommy's Express car wash are incredible, and accredited investors have the chance to join them on their adventure. Dave Zook, the founder and CEO of The Real Asset Investor, and his team are thrilled to share opportunities like Tommy's Car Wash with accredited investors that boost your cash flow, unlocks massive tax benefits, and get you set up for a lucrative exit just a few years from now. To learn more about the opportunities offered by The Real Asset Investor, you can reach out to them at info@therealassetinvestor.com. That's info@therealassetinvestor.com. So, Kevin, where can people, if they're interested to learn more about this asset class and obviously follow you guys, or just get in touch and obviously learn more about what you guys do and what you have to offer, what is the best way that they can do that?
Well, the easiest way is going to be go to we have a website, thepenumbraplan.com. The Penumbra Plan is spelled P-E-N as in Nancy, U-M as in Mary, B-R-A, plan.com. The penumbraplan.com. There's a short 12-minute video that explains everything that we do and how we do it. It's password protected. They have to enter the password of Penumbra, P-E-N-U-M-B-R-A, all lowercase, and watch the video. They'll have to put in their email address in order so we know it's a real person. And then they can watch the video, and then from there they can request a phone conversation, or they can call us directly. The phone number here is area code 817-479-9770, or my direct line is 817-479-9773. I'm happy to take a call and speak with potential investors directly. We don't allow any salespeople or financial advisors to sell this. We determine if an investor is suitable for our investment ourselves. We don't rely on anybody else. So we want to make sure that this is the right fit for them, and so that's how we do it. Is people can call us directly, or go to the website and view the video presentation, and request a consultation subsequent.
Fantastic. Well, thank you so much for coming on the show, Kevin. Again, I always appreciate and enjoy our conversations. And thank you so much for sharing your insights and your knowledge around the asset class of life settlements.
Always a pleasure, MC. Happy holidays, and I hope you have a good, safe holiday season.
Same to you, my friend. And thank you so much for all of our listeners and our viewers for spending most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. Until next time, live infinitely. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.